To keep yourself updated, subscribe to Indigo Learn and click the bell icon.
Let us have a look at the advanced accounting paper of November 2018. If you are still writing the exams, I suggest that you don't watch this video now. You can do it after all your exams are over. So let's straight away jump into the first question. It was from Accounting Standard 20 on basic earnings per share and diluted earnings per share. And the information regarding the net profit and the number of shares, it was directly given in the question. Just you had to divide the net profit by number of shares, and also the information around the number of debentures, the interest saving and the tax saving on that. Everything was directly given in the question. There was nothing to be computed. Simply if you knew the logic, you could have straight away computed what was the basic earning per share and diluted earning per share. Moving on to the next question. The second question was on purchase consideration from Accounting Standard 14 or the amalgamation chapter, where one company took over another company. In this, the special point was point number 4, where debentures of Reena Limited will be converted into equal number and amount of debentures of Teena Limited. Now, we know that when we compute purchase consideration, whatever is paid to the shareholders, whether in the form of cash or in form of shares or in form of debentures, only that has to be considered. This fourth point should not form part of your purchase consideration. And in your examination, you should have written a note stating that whatever is paid to the debentures, or if the debentures are converted into other debentures, that will not form part of the purchase consideration. So this was also a straightforward question asking you to prepare a journal entry. So 4 points, maybe 4 marks, and journal entry would have been another 1 mark. Looking at the third question, question number C, it was from Accounting Standard 18 on related party disclosures, and pretty much straightforward question. In the first question, it says Mr. Sumit, a relative of managing director, he received a remuneration of 2,10,000 for his services from 1st April to 30th June, and he left his service on 1st of July. Now, whether on 31st March 2018, as per AS 18, disclosures need to be made. Now, the fundamental rule is, if there is any transaction with a related party during the year, it has to be disclosed. Though on 31st March, this person is not a related party, but during the financial year 17-18, was he a related party? Yes, he was a related party for 3 months, and in that period, he received a salary of 2,10,000. So, relative of key managerial personnel. Under that point, Mr. Sumit is a related party, and hence disclosures must be made. Come to the next part. Goods sold amounting to 50 lakhs to associate company during the first quarter ended 30th June 2017. After that, related party relationship ceased to exist. However, goods were supplied as was supplied to any other ordinary customer. So, what does it talk about? It talks about goods sold during the first quarter. After that, the relationship ceased to exist, and goods were supplied as was supplied to any other customer. So, whether the transactions are as with other customers, or whether it is at arm's length price, whatever be the nature of transaction, if there was a transaction when relationship exists, it has to be disclosed. So, even the second point, there must be a disclosure, because for the first quarter ended 30th June, there was a transaction. Relationship ceased to exist only after the transaction. So, whatever transactions were incurred till the first quarter, that needs to be disclosed. The fourth question was on a guidance note to Schedule 3, which talked about convertible bonds which are due to mature on 30th September. Now, the question here was more about whether it should be a non-current liability or a current liability. And friends, we know as per Schedule 3, if anything is falling due within 12 months as on the balance sheet date, it has to be a current liability. So, the bonds, convertible bonds which are maturing on 30th September, as on 31st March, the company would have reported it as current liability. Now, the question tries to confuse and say that what would happen if it is likely that it would be converted, or if it is not likely that it would be converted. Whatever be the case, whether it is likely that it will be converted or whether it is unlikely that it would be converted, still then this has to be a current liability. So, first 4 questions pretty straightforward, and I hope most of you would have done it well. Now, coming to the second question. Now, this question was more or less adapted from an existing question given in the study material, which talks about certain average profits which has to be achieved. If those profits were achieved, or if those average profits were achieved, the options would vest. Otherwise, it would vest in the next year or in the third year. So, there was a 3-year term. In the first year, if you see, the profit earned is 14% and the target is 15%, means it will not vest in the first year. So, we will have an assumption that in the worst case scenario, in the second year, the options would vest, and accordingly we will consider 2 years to compute the expense. And when we come to the second year, the profit is 10%, 14 plus 10, 24, by 2 is only 12%. Still, it does not meet the 13% criteria which is set in the second year. So, here we will consider that it will vest in the third year. And when you come to the third year, If the average earnings will be 10%, so 14 plus 10 is 24, 24 plus 8 is 32, 32 by 3 is more than 10%. So the options would vest in the third year. A proper working note to allocate the expenses on year basis, that would have helped you to solve the problem. Moving on to the next question, which was on underwriting, a pretty much straightforward question where the question had clearly mentioned that credit for unmarked application to be given in the proportion of shares underwritten. So no assumptions required. Whatever are the unmarked application, divide them on the basis of shares underwritten, and firm underwriting is to be given to the individual underwriters. And we know whenever the benefit of firm underwriting has to be given to the individual underwriters, whatever was the firm underwriting, 35,000, 20,000 and 22,500, you will have to deduct it from the respective underwriters, and at the end to arrive at the liability, you will need to add them back. And the question was to compute the liability, the simple table that you prepare, then amount payable or due, again this can be derived from the table, and then passing the journal entries. A very much straightforward question, an adaptation of question from the study material, and here also I believe you would have scored 10 out of 10 marks. Moving on to the third question, this question was on liquidation of companies, and you are required to prepare receiver statement and liquidator statement. Most of the things are common adjustments or common terms used, so this should have also been easy to attempt. There was no specific adjustment required in this particular question. You just needed to identify what was realized by the receiver, you put them under the receiver account. What was realized and settled by the liquidator, you put them under liquidator account. Only thing special here was there were shares which were partly paid up, means face value of 10 rupees and 8 rupees was paid up. In such a case, what do? You make a notional call. When you make a notional call, you realize whether finally something must be received from these 50,000 equity shareholders. Based on that, you will give your final answer. If nothing was required to be recovered and if amount was to be paid, you will pay these partly paid shares, but the amount of payment will be 2 rupees less than the fully paid shares. And also on the dividend part, it is given in the question that preference shares dividend, they must be paid first before you pay anything to the equity. So even that has to be considered. The next question is on internal reconstruction. So where we have some cumulative preference shares, debentures, we have equity shares, and then creditors, provision for taxation. The only thing special here is the amounts are given in thousands. So you must be very careful when you are reading the numbers. Here the amount are given in 1000, but when you come down in the adjustments, you are given numbers in absolute terms. So this is not to be read as 525,000, it has to be read as 525. So the first adjustment, investments are to be brought to their market value. So the market value is given in the question at 3,325,000. You just need to bring them to the market value and debit to your capital reduction account. Moving on, taxation liability is settled at 525,000 out of current assets. So what was the taxation liability in the question? The question has given a taxation liability at 350 and it was actually settled at 525, means 175 was what was excess paid. So one thing would be to debit the capital reduction account by 175, debit provision for taxation by 350 and credit the current assets, which includes bank balance, by the corresponding amount. Moving on, balance in P&L to be written off, it is a simple adjustment. Then existing equity shares reduced to 4 rupees. So here from 10 rupees, the value has to be brought down to 4 rupees. Friends, I hope you have not done the mistake of reading this as by 4 rupees. It is to 4 rupees. So what is the reduction? The reduction amount is 6 rupees. The next adjustment, preference shares are reduced to 60 rupees. So here also preference shares value has been reduced and the face value, which was 100 rupees, it has come down to 60. So 40 is the reduction. Then see this interesting adjustment. The rate of interest on debentures is increased to 9%. So this will not impact the books of accounts. Debentures holders surrender their existing debentures of 100 rupees and exchange them for fresh debentures of 80 rupees. Each old debenture is exchanged for one new debenture. So what does this mean? The debenture holders had debentures having a face value of 100 rupees. They gave those 100 rupees back to the company and in turn they got 80 rupees worth of debentures. Means the face value of the debenture is now 80. So 20 is the amount that these debenture holders have sacrificed, which must be credited to the capital reduction account. I hope you have done the adjustment correctly. Then fixed asset written down to 80%, means whatever is the existing into 80%, 20% would go to capital reduction account. And one of the creditors for 70 lakhs gives a 50%, means 35 lakhs has to go to capital reduction account and he is allotted 8,75,000 shares of 4 rupees each in full and final settlement. So out of 70 lakhs, 35 lakhs goes to capital reduction account and balance is settled by issuing 8,75,000 shares of 4 rupees each. So 875 into 4 makes it 35 lakhs. So there is no premium attached to the issue. Past journal entries for the above transaction, and I hope you have also prepared the capital reduction account as a working note to give effect of the journal entries, and finally passing the entry to transfer the balance of capital reduction account. Moving on to the next question. This was a question on an insurance company and it was more about preparing a revenue account with simple principles, that is premium. There was some opening balance receivable, there was some closing balance receivable, and there was some amount received during the period and paid during the period. With these 4 information, you can identify what is the income. Same way you can identify how much is the claim that has been incurred for the current period. With these 2 and other information like commission and other expenses, it was very straightforward to prepare the revenue account. It was a very straightforward question, no complications given in this particular question. The next question was on NBFC provision norms. The numbers were clearly given in the question. You need not worry whether you should have classified it as standard, substandard, D1, D2, D3. All those information was directly given in the question. What you needed was what is the provisioning requirement under 2 cases. What are the 2 cases? The first one was non-systematically important and the second one was systematically important. So you just needed to remember the rates, and we know that only the rate pertaining to standard assets would have changed, rest all would have remained same. So you prepare 2 tables and compute the provision. Again, a straightforward question. If you would have remembered the rates, it was an easy question to crack. Moving to question number 5 on profit and loss account for consolidation. Again here, simple question where you have to do the necessary adjustment to eliminate intercompany transactions. Whatever the expenses have been paid by one company to another company, or whatever income has been earned from another company, those have to be eliminated. And if there was any unrealized profit, so which is given in the first adjustment, goods of 180 lakhs sold to B Limited at cost plus 25%. So how do you solve this? If cost is 100, profit is 25, selling price is 125, and 1/6 of such goods were still in inventory of B Limited. So the subsidiary company still holds those goods as its inventory. So this portion of profit which is unrealized, that must be eliminated, which must be adjusted. And others were very straightforward adjustment which you could have done and arrived at the consolidated profit and loss account. Moving to question number B, it was on finding out the average capital employed for each year and value of goodwill at 4 years purchase of super profits using simple average method. So the question has clearly mentioned you have to use simple profits and you must find out average capital employed in each year. Each year meaning what is the average capital for 16, 17 and 18. Now to compute the average capital employed of 31st March 2016, you have been given the information regarding what is the capital employed at the business in the beginning of the year. So this information was given, this amount plus whatever is the capital employed at the end of the year. The sum of these two divided by 2 would have given you average capital employed. And then you move on, you compute for 31st March 2017 and 31st March 2018 using the principles that you have learnt in valuation of goodwill. And how do you compute the goodwill? You find out what is the average capital employed, what is the normal rate of return. Normal rate of return is given as 10%, and what is the actual return, whatever is the differential based on the future maintainable profits, you compute what is the value of goodwill. Looking at question number C, the first question was on equity shares with differential rights, where equity capital is held by 4 people and preference capital is held by 4 people, and the ratio is 60 lakhs to 30. So 2/3 is owned by equity, 1/3 is owned by preference. This 2/3 you distribute between L, M and O in this ratio, and the 1/3 you distribute between A, B, C, D in this ratio. Whatever percentages you get after this distribution, that would be the respective voting rights. Moving to 6B, what are the initial disclosure requirements of AS24 for discontinuing operation? This is a pretty much straightforward theory question as to what are the initial disclosure requirements. Now, when an operation is identified as discontinuing, what are the disclosures to be made for the first time? That is what this question has asked. So, it's a straightforward theory question. Moving on to the next question, question number C. Again here, there was a mutual fund which has raised certain funds, invested, then sold, earned some profit, distributed some profit. a study material question where just the numbers have been twisted, and this was a straightforward question where you were expected to score 5 out of 5. There was no much complexity in this question as well. Looking at question number D, it was on rebate on bills discounted. So you have the opening rebate, you have whatever the discount has been received, and then based on this information you have to compute what is the unexpired discount or what is the discount pertaining to the next financial year. What are the number of days that are remaining after 31st March, and applying the rate of discount which is 14% per annum, you could compute what is the amount of rebate that has to be created, and this rebate amount pertains to the next financial year. Once you computed this number, passing journal entries would have been easy. Looking at the last question, this was again on mutual fund. So 2 questions from mutual fund in the same question. So question number 7 has 2 mutual fund questions. Now this was again an application of SEBI guidelines. Now the question says, this mutual fund asset management company wishes to invest 25% in an unrated debt instrument. Stop there. The moment you say this 25% and unrated, you will feel that this is within the limit. But friends, this limit is for all the unrated debt investments of different companies. But in one company, we know that the company can invest only 10%. Now, the question again says, will the position change in case the debt instruments of the company were rated? Now, will the position change if they are rated? Friends, even in case of rated debentures, the maximum limit is 10%, which can be increased to 12% for a single company. So in one company, the mutual fund cannot invest 25%, whether it be rated, whether it be unrated. I hope you got a broad overview of how the question is. We will be soon putting out the suggested answers for these questions.